He's running the YouTube link.
Recording in progress.
Okay, we're live.
Okay, so we will go ahead and call the meeting to order at 1:02. And we'll do a roll call. And just so you understand that we're still working in a Brown Act capacity. So when we get to the action items, Kristen will do a roll call and you each will say aye or nay or abstain. Okay? With that said, we'll do a roll call. Vice President of Business Services, Marlene Drinkwine.
Here.
Director of Business Support Services, Robert Raposa.
Here.
Director of Fiscal Services, John Thompson.
Here.
I'm Rosalind Washington of Keenan Financial Services. We have Kristen Cooper of Keenan Financial Services. Scott Rankin of Benefit Trust Company.
Here.
And Carrie Allison of Morgan Stanley.
Here.
And then we also have Dario DeSantiago of Long Beach Community College District running the IT for us.
Rosalind, can I ask a question, Rosalind?
Absolutely.
Carrie, which other meeting do you show up for? SWAC board, SOUP?
SOUP.
SOUP. All right, that's where I know you. Okay.
Yeah.
Yeah.
We meet in Long Beach quite often.
Oh yeah? Yeah, it's just funny. I recognize you and I go, hey, wait a minute.
Yeah.
Is that it, Robert?
Yeah, that was it. Just wanted to find out. Thank you.
You're welcome.
Yeah.
Okay, first item is public comment. I don't think we have any public in the room other than Dario. So we'll move.
And I assume Shonda would have forwarded us. I haven't heard anything from her, Marlene, on that. Have you?
No, we have not received any emailed public comment.
Okay, great. Thank you. Okay, so if you can all see this rather clearly, we'll go ahead and move to approve the agenda, please.
I move.
Thank you, John.
Second.
Thank you, Robert.
Sure.
And I'll take a roll call vote. Marlene?
Aye.
Robert?
Aye.
John?
Aye.
Thank you.
Okay. Our next item is the approval of the minutes. So we'll go through the minutes. Our last meeting was held on June 18th, 20. These are the wrong minutes.
2019?
I know.
I thought we had a meeting last year.
We did, Carrie.
Yes, we do.
Oh, okay. No, right, just thinking, well, I have a lot to cover.
Oh my God, I didn't even notice that. Hold on one second. No,
Our last meeting was on June 16th of 2020.
Right. Hold on one second, because I can pull it in. I put the wrong meeting minutes and I didn't even notice that. 1 second. Can you all see this? Can you see this document I'm sharing now?
Yes, we're looking at page 10 of that starts with the market overview, item 2.
Okay, no, hold on a second. Sure. I pulled up the minutes from there. Can you see this?
There you go.
Yes.
Okay,
Yeah.
these are the minutes from June 16, 2020. I apologize for that. I'll just kind of scroll through and then someone can open a motion to approve the minutes.
I'll move.
I second.
Marlene and Robert?
John, but
Oh, that was you, John? Okay.
either way.
We'll take a roll call vote. Marlene?
Aye.
Robert?
Aye.
John?
Aye.
Thank you.
Welcome.
Thank you. Okay, let me go back to the other document. Can you see that?
No.
We don't see a document yet.
Okay. I was just telling Dario how wonderful I was at sharing documents now.
There you go.
I spoke too soon. Okay. Forgive me, we bounced back now. Okay, so we have that. So now we're going to move into the portfolio performance review. And this is the performance report from May 31st. Carrie, you want to go from here?
Yeah, absolutely. This is May 31st. And then I've actually got an update as of last night's close. We're a little over 100,000 above it. We're at $10,910,120. So $10,910,120. So what that means is a return, year-to-date return of 4.5% through yesterday's close. So again, as Roz says, this is as of May 31st. So we're at 10 million, I'll call it 800,000. See the asset mix there on the upper left. The alternatives are real estate investment trusts, publicly traded real estate. So let's look down at the total account net of fees. For the year to date, your account is up 3.48%, up 20.69% over the last 12 months, 881 per year over 3 years, 819 per year over 5 years, 5.83% per year over 10 years, and 5.63% per year since inception. You see the assets let me also look at the year to date and the 12-month numbers. Let me look at those for the different asset class. First, the S&P 500, up 12.63% year to date and up 40% over the last 12 months. Now remember, that's off a very low base end of May last year. The next two are international indexes, up about 10%. And those are up 38 and 42% over the last 12 months. Barclays aggregator US bonds down 2.3% year to date. Bonds have been down so far this year, and that's because interest rates have gone up. But notice one column over quarter to date. See, the Barclays aggregate is up 1.12%. Interest rates have come back down a bit, and we'll talk about that. So the loss for the year is only 2.3%. It was over 3% about a month ago. Last 12 months up, down 0.41%. Global bonds up 2.21% for the quarter, but still down 2.34 year to date, and up 4.48 over the last 12 months. And finally, we like to show you a 50-50 mix. It's not a benchmark, but just a handy number to have. Up 6.42% year to date, up 21.87% over the last 12 months. As far as, if you could turn to the next page, Roz, we do make portfolio changes every now and then, on an as needed basis. And the way it works is Morgan Stanley makes recommendations to Benefit Trust Investment Committee. And if their investment committee approves them, then they enter your portfolio. There's a few different new funds in there. You see the third one from the top, Guggenheim Macro Opportunities Fund. That's a new fund in there. Look down a little further under mid cap. There's a Alger Funds Mid Cap Focus. Turns out if you look down below that, there's an Alger Fund Small Cap Focus managed by a gal named Amy Zhang. We've held this fund for over 5 years. It's your best performer over 5 years. Well, she now also manages a mid-cap focus, same style as the small cap focus, just larger companies. So we added that one. And if you look one above there too, there's Legg Mason Partners Equity Trust Clearbridge Select Fund. It's kind of a mouthful. Legg Mason Partners Equity, 287,000. We added that one as well. And they're probably up 15% so far this year, and they're up about 58% last year. So those are the changes we make. We usually don't go into a lot of detail on the changes, but just wanted you to be aware of the process we go through in recommending changes to benefit trusts, and that's how they end up in your portfolio. Any questions on the performance report itself?
When you make changes, is it to kind of, because I know we have like a target balance of, and I'm not sure exactly, but like 40% equity, 60% other. Are the changes to kind of get back in that balance or for other reasons?
No, that's a great question, John. We can change the asset mix of stocks versus bonds, but that was not what this change was. This change was changing out of some managers into other managers, but your mix between stocks and bonds or your overall risk level did not change with these changes.
Oh, okay.
And John, another point along those lines, you're in roughly our 50-50 portfolio. You're not going to log in one day and notice that you're 60% in equities or 40% in equities. You signed up for a certain risk level, you're going to stay right around there. Yeah. Any other questions on the report itself?
And remind me, I know I glanced at it a while ago, but these numbers are as of like March 31st. Is that right?
This is March 31st. That's correct.
Oh, it's May 31st, Carrie. May.
Oh, I'm sorry. May 31st. Thank you, Roz.
Okay.
Any other questions on the report itself before Carrie goes into a more in-depth market overview? Not, can we get a motion to accept the report, please?
I move.
Thank you, John.
I'll second.
Thank you, Marlene.
And one more time, Marlene.
I'll second.
Robert.
Oh, sorry, I apologize.
Thank you.
Aye.
Thank you, John.
Aye.
Thanks.
Okay, Carrie, you want to bring us current on what's going on in the market now?
Yeah, lots to cover, so I'm going to speak quickly, so please interrupt me at any time. But there's some current controversies going on in the market I want to address. But first, let me give you the big picture. The big picture is that since we met last June, Morgan Stanley has gotten quite bullish on the economy. We feel very positive about the reopening, the vaccine rollout, the trend of COVID cases and deaths, and believe that consumers have record amounts of savings right now and a lot of pent-up demand, which is going to cause the economy, and don't laugh when I say this, but we believe the economy could grow 7.5% to 8% this year, 2021. Can you imagine that?
That'd be insane. When is that ever
crazy?
Yeah.
Well, it was 1984.
Wow.
I think Rosalind was 2 when that happened. Yeah.
Thank you,
1984. So very strong economy this year and still a 4.5–5% growth next year. A lot of this has to do with the fact that the economy was just absolutely smoking red hot last January, February, going into the pandemic. Then we shut the economy down. Government money came in, supported the bond market, supported the economy in ways that we literally haven't seen since World War II. The magnitude, I can't even begin to tell you. And we could be paying for it for a while. But nonetheless, a lot of money went into the economy. And now we're just coming back with a vengeance. So the controversy right now is, what about inflation? And what about interest rates? You're hearing a lot about inflation. Morgan Stanley thinks inflation is going to be a little higher. The Federal Reserve Board believes that most of inflation is what they call transitory, meaning one-time type inflation. You can't just flip a switch to get the economy back up and running. It's just there's too many components that fit together. There's literally hundreds of thousands of Ford trucks sitting somewhere in Michigan that are lacking semiconductor chips. They can't sell them because they're lacking chips. Just as an example, supply chains have gotten disrupted with shutting the economy down. So as you reopen the economy, it's just very lumpy and which has caused a lot of one-time inflation. Federal Reserve Board thinks most of the current inflation is one-time oriented. Morgan Stanley thinks a little bit more of it is long-term oriented, is going to be with us here for a while. Now, the controversy is some of your money managers, mainly Guggenheim, if anyone called into our last phone call a couple months ago, the Meet Your Managers call, I got to interview our Guggenheim bond manager, and they're based out of Santa Monica. They're one of our largest they are our largest bond managers in Futuris. They went into a lot of detail explaining how almost half of the increase in inflation came from less than 5% of the CPI index, meaning things like, you all had heard about lumber, right? Lumber's up almost 400% over a year ago. And some other items have been up dramatically. Yet what they're not telling you is that stumpage, or the raw material that goes into making lumber, their prices are actually flat to slightly down over the last year. So the reason it's up is because of other reasons, not stumpage, which is typically the cause for longer term inflation. So because of some issues like that, as well as the fact that Guggenheim believes that the government support of income is what's really driving a lot of this spending. And then once that government support goes out, income is going to be lower than it was before COVID. Now, that's not to say we're going into recession. Not at all. Still very strong economy. But their thinking is once you get rid of some of those supports, general long-term inflation is probably going to go down. And so you've got kind of these two competing thoughts of what's going on. Well, last week, the Federal Reserve met, and as they do each quarter, and Chairman Powell talks to the financial markets and they explain what's going on. And what they did is they greatly increased their expectations for inflation over the next year, okay, which is what we thought they would do. They had greatly underestimated inflation. So what does the bond market do? Well, the bond market, interestingly, long-term interest rates dropped. We were about 1.55 to 1.6% on the 10-year Treasury. Now we're at 1.46% on the 10-year Treasury. So long-term rates came down 15 basis points, which is kind of curious. So if inflation's really high, how come long-term rates are coming down? So that's where I tend to be more of the thinking that most of the inflation is transitory in nature, would probably go down. And because otherwise we would see the 10-year and the 30-year interest rates move up quite a bit. Now, we may see them move up. We're watching that. But our long-term theme is that long-term interest rates are going to stay on the lower side for longer. And inflation, once we get past these reopening jitters and uneasiness or unevenness, we're going to move back down to about a 2% inflation rate long-term. And part of the reason that we don't think inflation is going to stay real high long-term is because of demographics, aging population. That means economies are slower growing, which means there's typically less inflation. Secondly is what we're doing right now, technology. The costs that are being saved in corporate America through technology like Zoom and different things is huge. We've never seen anything like this. And we believe we're still in the early innings of seeing that technological revolution. So how we position your portfolio is you've always got a balance of everything. We're never making just one bet to happen, but we are overweight growth, more the technological and the healthcare, what we would call the disruptive technology companies, and underweight more the value type companies. We're not real short in duration on the bond side. We've just got meaning intermediate duration tilt on your bond portfolio, which basically means we're not too concerned about long-term rates. In fact, we think long-term rates may even come down a little bit. So what does all this mean for your portfolio? Well, already you're up, almost 5% year to date. Our target for this portfolio, I believe, is about 6 to 7%. If we could get a couple of percent by year end, I'd be thrilled. It's going to come down to earnings. Where do earnings come out for all these companies? If earnings continue to grow at a very strong rate, which we think they will, we think stocks could earn 7 to 8% a year, per year going forward. But since interest rates are so low, we think bond returns are more in the 2.5%, 3% range. We do think energy is going to tend to be, gas is going to be a little on the higher side, like we've seen. I mean, California, oh my goodness, you're probably up to $5 down in Long Beach, huh?
Or something.
We think it could go down a bit, but not that much. The policies out of Washington tend to be a little more anti-fossil fuel. So we think that's hurting it, gas prices a little bit. So, that's our big picture view of what we think is going on. Any questions about anything?
I appreciate the detailed overview. That was helpful.
You bet. So we'll be watching inflation and interest rates, see where those end up.
I don't know if it was in one of your, one of the Meet the Managers, but I heard one description was when people worry about the government paying out money to individuals where people are worried about that might cause inflation. They were saying that there was such a dip in the economy that instead of that money kind of being a mountain, it just kind of fills a valley that existed because of the pandemic and the recession that followed. Is that your thinking, or?
Well, almost, but it's even more that, John. It's the amount that income went down during the second quarter last year because of the pandemic. It was more than filled in by the subsidies from government. So that aggregate income actually went up, if you can believe that.
Wow. Yeah, I heard I didn't, look into all the details, but I heard something about restaurants now that they're opening back up are having trouble getting staff because some people are figuring they're better off continuing to get unemployment and not wanting to come back to a job
That's true.
Yeah, John, that's absolutely true. There's in certain states, depending on how the unemployment numbers are working, you've got greatly enhanced pay through the first part of September. It's like, well, why go back to work? I saw a sign, I think it was for a restaurant in New Jersey, that said $20 an hour, 401k, $2,500 sign-on bonus.
Right.
Because
Carrie, can you send me the link, please?
Carrie, that does beg the question, though. I mean, there's that common economic understanding that as unemployment decreases, then inflation increases. I mean, you have a relationship there. Mm-hmm. And right now, our unemployment trends are like an aberration. They're not typical. So I wonder, I got to think that relationship is not as easy as what it looked like historically.
No, Marlene, I think you hit a great point, and I'll use this analogy. I think it's really difficult to compare year over year stuff with last year, because last year was such an anomaly. Right. It'd be like I mentioned earlier in the call that I'm a very bitter Sacramento Kings basketball fan because we always do the wrong thing all the time. But I'll get off that. But that would be my analogy, would be a basketball analogy. It would be like comparing a player's stats this year versus last year when he was out with an ACL injury. How do you compare over last year? It's just, you don't have pandemics that often. I've never seen one. So what is this going to look like 6 months from now or 12 months from now? But we do know, Marlene, that there are more job openings than there are unemployed people. Pretty interesting.
In a normal year, that would mean we would anticipate inflation.
Correct. Yes. A lot of, because, and wages are going up. Absolutely. And that's been a big driver of inflation.
Right.
So
yeah, good point.
Carrie, do you think long-term though, the goal will be to keep the Fed's goal will be to keep interest rates low, to keep the cost of financing the the bailouts relatively in check, because if inflation takes off, that's going to really erode the value of the dollar.
Well, not to depress you all too much, but the chief investment officer of Guggenheim, I was on an hour-long call with him a couple of days after Chairman Powell met last week, and he just came out and said that the Federal Reserve just displayed why they have no idea what they're doing. That was Scott Minerd's words. Because but you're right. We are in an experiment we've never done before. Right. So we don't know. What they're hoping is that while they're issuing all this new debt and then printing money on the other hand to buy half of it, that's not going to cause too much inflation. We don't know. It hasn't yet. There's this thing called velocity of money. There was a lot of this going on in 2008. It didn't cause the inflation that people thought it was going to, because the money got in the economy, but it didn't multiply a lot. A lot of that had to do with the fact that banks kept a lot of the money on the sidelines. They didn't lend a ton of it out. We got to see what happens right here. Guggenheim is of the impression that that's not going to happen. But we don't know. Now, Guggenheim also said, though, some point in the next 10 years, we are going to have a lot of inflation. We absolutely are. They just didn't see it in the next few years.
Because hasn't the Fed in the most recent couple of years been taking action to hold inflation? And so there's only so long they can take those same actions before the market just starts to go screwy.
Yes, the Fed has a dual mandate: inflation and employment. So they can manipulate the monetary base through buying and selling securities and interest rates to meet those two goals. So they have a lot of leeway in how they could do that. Now, recently, they've also come out and said that they're looking into racial equity for employment and climate change as that affects employment, and that could factor into monetary policy. I don't even know what that means. But what we do know is that the Federal Reserve has been using a lot more powers, and that's really grown over the years. But so to Robert's point, though, most of the new U.S. debt is issued as 2-year treasuries. So if the Federal Reserve raises short-term rates, that means their borrowing costs go up. There's a lot of debt out there. So, this is my California state school education that says that there's a motivation to keep rates lower. Let's just put it that way.
Yeah.
Because, and I don't think that takes a rocket science to figure that out. So,
it seems.
Go ahead, Marlene.
It seems like we've been talking about strange economic cycles for like 4 or 5 years now, that our economy kept growing and we were reaching record-setting growth, and we all kept waiting for that cliff because that couldn't be sustained. And instead we had a pandemic, but then the economic impact of the pandemic turned out to be what we didn't anticipate, that we now know that many sectors benefited while some specific sectors didn't. And so it just seems like we continue to be in, for one reason or another, just this really strange moment in history where everything in the economy is an anomaly. Everything is not acting like it normally does, and that our ability to project is impaired. It's like we all have glasses that don't fit,
I'll have two comments, and I think those are some great points, Marlene. Number one is COVID was the greatest thing in the world for certain industries last year. Do you think Amazon benefited last year?
Oh, God.
Microsoft,
Still benefiting.
Zoom, anything cloud related. There's a company called Shopify. They're a company that helps small businesses put their businesses online. Think about that. They help companies go online. Their CEO claimed last summer that they had 10 years of growth in 2 quarters. But then on the other hand, cruise lines, hotels, airline, they didn't do so well. But they got billions of dollars from the federal government. I got a buddy of mine who runs a Chick-fil-A. He had a record year last year. Yet they also got all that PPE money. So he got, however much money he got, I have no idea. And they had a record year. Because, when you don't go into a Chick-fil-A, they don't need as many employees. McDonald's had record years and so on. So you're right, Marlene. There were some areas of the economy that absolutely benefited last year. There were others that not. The thinking about that there's a point down the road where it's unsustainable is that I would use this example. We've been spending 2 to 3 trillion more than we bring in as a government the last year and then this year. If we just said we're going to be 3 trillion under budget or over budget, say the next 10 years, there is a point at which you just can't sustain that. Maybe the US doesn't become the reserve, maybe we lose our status as a reserve currency. We have that right now. I don't think we're going to keep $2 to $3 trillion deficits every year. If we do, yes, that would be a big problem. But we have been talking about this for a while, and we're now at deficits like we've never seen. Japan is an example of that, where they've got huge deficits relative to their economy, yet they've got 10 and 30-year interest rates nearly at 0%. This is a grand experiment. We've never done it. So I don't know what to say, Marlene. I'm just kind of trusting my bond managers, because I love listening to bond managers because they're paranoid of inflation. If you own a 30-year bond and rates go up, you're a technical economic word, you're screwed, return wise. So and how we've got your portfolio mostly invested in is these disruptive technologies that truly are changing how we do everything. Roz, how much are you using DocuSign now?
Every day.
That's just been a heaven send,
Yeah.
Company like that, it makes perfect sense. We've been dying for a technology like that for years.
Mm-hmm.
And finally, like the regulators and the companies have started allowing it last year. What does it look like a few years down the road? Well, I think DocuSign is going to have a pretty good business a few years down the road as well.
Mm-hmm. So Carrie, let me just ask you a couple questions before we move on. So the end of the year, you had stated that the interest rate, the Feds were going to keep interest rates at 0 through like 2023. Do you still feel like that?
Well, the market's thinking that they're going to start raising short-term rates next year. That's what the market's anticipating, like middle to late next year. You can go into the futures market and people can bet on when they think the Fed will raise rates. So you're right, Roz. Instead of 2023, they've moved that up to 2022.
Okay.
Guggenheim still thinks 23, maybe even 24. Morgan Stanley is probably early 23. So I personally think we got to check the next 6 months of economic data and inflation, see where that turns out.
Okay, and then last question, Carrie, that new infrastructure bill that Biden has, is that going to affect the market in any way? If that goes through?
It could. It just depends on how much it is and how big it is. If it's $2 trillion and we actually spend the money in a short period of time, that could have inflationary consequences. Our thinking is that the corporate tax hike and any individual tax hikes are pretty much off the table at this point. There doesn't seem to be appetite for that. Even though the Democrats have a 51 to 50 advantage in the Senate, they still have a filibuster rule. They haven't voted to get rid of that. Right. And so far, a couple of Democrats aren't willing to vote to get rid of that. So if they aren't, they really don't have 60 votes to raise taxes. So we do have some tax changes. We just don't think they're going to be major at this point.
Okay, I was just curious as those two things. Thank you.
You bet.
Any other questions for Terry on the market before we move over to Scott at the review of the investment policy statement? Scott, you want to
Yeah, go ahead and pull that up there. We do have some red lines we're suggesting this time for compliance purposes. As you know, GASB rules 74 and 75 have now superseded 43 and 45. And the rest of the changes that we're recommending to the investment policy statement basically follow with those rule changes. And Roz, if you could scroll down. Actually, if you could just take us straight down to page 40.
To the appendix.
And I'll just try to explain things from there. What has occurred is actually a kind of a long story, and I'm going to try to make it as brief as possible. But back in 2006, when we started this program, we spent a lot of time with our actuarial consultant partners and came to the conclusion that it would be best if the investment policy statement was stated in terms of a target rate of return. And John, you've been with us clear back to 08, I think. So you know we've talked a lot about target rate of return. But the story there is that back in those days, the actuaries would basically take that target rate of return and use that as their discount rate and plug that straight into their calculations and go on down the road. What GASB, the Governmental Accounting Standards Board, determined the last several years is that public entities all over the nation have been taking advantage of that privilege, and they were grossly overstating their target rates of return in order to keep their calculated unfunded liability low. Because if the discount rate is high, then the unfunded liability is low. And what they started doing was looking at portfolios and realizing that people were declaring a 10 or 12% target rate of return for an entirely fixed income type of portfolio, which could never earn that. And so when 74 and 75 came out, one of the changes that was made was they wanted the actuary to actually do a personal review of each investment portfolio and apply a set of rules and come up with their own calculated expected rate of return and apply that to their discount rate calculation, taking the target rate of return clear off the table. And what we found with several of our clients is that is now leading to some difficult conversations with the actuary, because they see a target rate of return in the investment policy statement. Now they think they're investment experts because they're calculating an expected rate of return, and conflict develops between those two. So basically this last year, we've gone through all of our clients' investment policy statements, and we've taken out the target rate of return language and changed that out for target asset allocation language. It doesn't affect anything that we do for you or the way we do it, but what it does is instead of the language here that you see on the screen, instead of seeking to achieve a target rate of return of 7% for the portfolio gross of fees, we would exchange that language for this other language, which describes the same thing. It just does it in such a way that it doesn't create conflict with the actuarial community. So here, because you're in the moderate growth portfolio, 45% equity investments and 55% fixed income investments, we changed that to a target asset allocation statement. And throughout the policy, wherever you find the term target rate of return, we've merely switched that out for target asset allocation. It's a pretty clean swap, but what it does two things. First of all, it brings the investment policy statement more in line with the current content of the GASB rules. And secondly, it brings your investment policy statement more in line with traditional investing. Because I got to be honest with you, before this, I had never once seen a target rate of return in an investment policy statement before. And none of my other clients that are not in this program use a target rate of return. Everybody talks in terms of asset allocation. And so it brings the investment policy back to a more normal way of managing the investments, as well as reduces the conflict. And so we propose these changes to you today for that purpose. Any questions?
Yeah, I appreciate the explanation. I know I've seen in our actuarial study reports the breakdown, and I've wondered sometimes where it might be slightly different, and I don't know if it's them, kind of missing something, and I think it's been slight where like they might break out, equities in international or domestic, or like Carrie was saying, the alternative is the REITs or whatever. And I know it's been a little tricky just kind of verifying that what they're showing on their report matches what you guys are doing, but it helps to have that explanation of that change and understand what they're doing going forward.
Well, and you make an excellent point, John, because our target rate of return is a long-term number. It's over a business cycle or longer, whereas their expected rate of return is supposed to be a 2-year number. And as we've seen the markets ebb and flow, we know that in the short term, expected rate of returns can't be expected, practically speaking, to achieve the longer term numbers. So you raise an excellent point there. That's exactly why those numbers are hard to match and hard to keep coordinated.
Especially, John, when GASB 7475 was introduced, because the amortization schedule was no longer 30 years, it was now 10 years. So that made it even more difficult for an actuary to try to match up his discount rate to the target rate of return, which he shouldn't have been doing in the first place.
Oh, okay.
Like John, I appreciate the explanation, and I understand the need to reflect it as the portfolio allocation rather than the targeted rate of return.
Very good. Any other thoughts or questions?
It's an action item then to accept the changes that are outlined here with Scott. If I can get a motion, please.
I would just say, I don't think we've changed that asset allocation in a long time. And obviously, in the performance, the equities are doing better now, but I still, like having the mix that we have with 55% in fixed. I mean, when we went back to the 2009 recession, everything was losing like 30% or something in equities. And so it's, nice not to have that potential of dropping too much if there is another big recession like that. So anyway, I guess with that said, I move to approve the changes Scott talked about.
Thank you, John.
I'll second.
Thank you, Robert.
And I'll take a roll call vote. Marlene?
Aye.
Robert?
Aye.
John?
Aye.
Thank you.
Thank you all very much.
We'll get the report over to you via our favorite site, DocuSign now. And then once you sign it, we'll get it back to Scott, and then we'll send you a fully executed copy for your records.
It's DocuSign. I've heard of DocuSign, but haven't used it too much. We're doing a lot in Adobe Sign, signing and approving things.
It's the same thing.
Same
I
kind
didn't
of
know
thing.
Adobe had a sign. They must have came right after DocuSign, because I didn't know Adobe had
it's helped us a lot. I just know how to click and sign on something, but thankfully my assistant knows how to set it up, route it for signature and all that.
Yeah, that's Chris's job. She's really good at that. So you'll see it come from Kristen, probably. So she does all that perfectly. I'm still in training.
Yeah, I know what you mean.
Okay.
Well, thank you all very much.
Thank you, Scott.
Thank you.
Our next agenda item is the annual report on the status of the trust. So each year we provide an annual cover letter that goes in front of your annual statement. I then send it back to you, and then it's posted onto the district website. And for whatever reason, John, when I was going through auditing our records, I don't believe that we had ever, and you can correct me if I'm wrong, that we had ever provided you with the cover letter and the annual statement. And you're usually pretty good about asking me for it. So maybe I'm wrong and I just didn't have it in my files. But do you remember if you posted the annual statement and cover letter this last summer in 2020?
Oh yeah, definitely. Yeah, we have it, and I think we have on our website all of the last 10 years or something like that. We have this cover letter, and then we attach the benefit trust annual statement for the year, our fiscal year ended June 30th.
Okay, great. I didn't find a copy of mine, but I know you're always the first person to ask me for it. So I was pretty sure that you had it posted. So are there any changes? We're going to do the same thing this year. We'll provide the cover letter. This is the same cover letter that will go in front of your annual statement ending June 30th, 21. And I'll get it out probably around the second week of July. But we have the primary contact person still being you, John. Make sure that that number is correct on there. And we'll get it over.
Correct.
Okay, wonderful. So that's just an information item. So we'll use the same process and we'll make sure to get that over to you by mid-July. Okay.
Sounds good.
Thank you. Our next item is the disbursement report. So as you know, our fees are deducted at the end of every month. The fees are based on end of month asset value. So these are the fees that were paid since we last met in June to Keenan Morgan Stanley, excuse me, and Benefit Trust individually. I'll just kind of scroll through so you can see the fees that were paid out, and then when you're ready, you can take a motion to ratify the fees.
I'll move to ratify.
John, thanks, John.
I'll second.
Thank you, Marlene.
And we'll take a roll call vote for the last time. Marlene,
Aye.
Robert,
Aye.
John.
Aye.
Thank you.
Thanks, everyone. That brings us to our next agenda item, the actuarial valuation study update. So let me go back, because I believe this report is dated
2019.
2019. And this is a full study. So let me start by asking, most of our clients do a full study and then in the off year do a roll forward study. Do you all not do a roll forward?
Yes. Since GASB 7475, we've been doing that. And I thought I sent it to you, but I can send it to you. But yeah, this is the last full study here, okay. And they will be working on, our payroll manager is busy right now, like we all are. We have a lot of turnover, but she's going to be providing the actuary with data that's needed, and they'll be working on the 2021, every 2-year full study that we need.
Okay.
So will you be able to, Rosalind, substitute the roll forward that John provides you for 2020?
What do you mean substitute it?
Well, I mean, just for the record to be, I want to make sure that we have.
Just send it to me, John, and we'll make sure that it's notated, in the minutes as far as the total liability, the typical items that I include in the minutes. So, because currently, as of 2019, your total liability was 36 million, and I know you just finished a huge CERT, right? So yes. The numbers may change, and I think that's probably why you're waiting to do a full study after the CERT numbers are in. But it had you with a net.
I'm not sure. I guess we can check with our actuary, but I mean, we're providing information right about now, so I don't know if it'll be June information. But I mean, we'll let them know.
I'm sure. So the actuary will need to have that information so that they can include it in their study. We had a very successful CERT.
Yeah, you did. It was really good working with you all. So at any rate, as of 2019, your net liability was 27 million, but that was when you had a net position in your trust of 8.6 million. So now if you're at about 11 million, so Carrie said, yeah, almost $11 million. So that brings down your total net liability, but we're not sure whether or not your total liability, your accumulated liability has increased or not. So once you get that information, John, when you get the full study, send me the 2020 study. When you get the full study, send it over to me and we'll make sure we at least update your substantive plan with that information.
Yeah, and they usually get that to us by the time our auditors do their field work, which is in October.
Okay.
Rosalind, do you mind just flipping through? I forget exactly where it is, but just since we were talking about the portfolio mix, yeah, maybe it's in assumptions or something like that. I just wanted to take a glance at that and see if there's anything I should follow up with the actuary on while, everybody's here looking at it. And then I think the auditors, well, I know the auditors include a lot of this in the audit report too. So it's kind of like looking from our target percentages and comparing to this report and to the audit report. Just want to make sure it is what it should be.
So where would that be? I know what you're talking about, John. Like I remember.
Yeah, maybe, I don't know if it's in definitions or somewhere in the back, but
Rosa,
yeah,
I think it's near the back.
Yeah, towards the end. Okay. Shows the trend 1% lower and 1% higher. There's the discount rate. He used 5.8%. The prior one was 4.5.
Yeah, here it is.
Here it is.
So I guess in total the 55% fixed, and they break out the 45. Yeah, so I guess that's in line with our investment policy, right?
Yeah.
Yeah, that's a lot closer than I would have expected based on others I've seen.
I know, huh?
Yeah.
Yeah, I forget exactly, but it seemed like in, maybe there was a difference or something in prior years, but I think it looks correct now.
Yeah.
Good for you.
Okay. Any other questions on the actuarial section? Okay. Thank you. That brings us to our next agenda item, which is the district's OPEB plan independent audit report. So every year I know I collect your actual district audit, but we add that to your substantive plan, but excuse me, some of our clients actually conduct an independent audit of the trust. And I couldn't recall if you were one of those clients for that, but I didn't see the report in our actual substantive plan. Can you answer that, John? Do you guys all do an independent audit of the actual trust? Or just
the trust is included in the audit report. They show like a separate financial statement, just the small balance sheet and income statement after our district-wide balance sheet and income statement. So it's included, just like our individual funds in our district are included in the audit.
Okay,
but there's not a separate audit, if that's what you're asking.
That is, and I didn't think so. I just wanted to be sure, because there's about 4 or 5 of our clients that actually conduct a separate independent audit of the trust. So.
No, we don't do that.
Okay, perfect. Thank you. So we have the document that we need. Okay, our next item is the update to the comprehensive compliance plan, the substantive plan. This is a questionnaire that was completed June 30th, 2020. There were several changes. I think we downloaded new bargaining agreements for your certificated and your classified bargaining units, as well as management. So that was included and updated in your substantive plan. I don't think there were any major changes as to the benefits that were offered to the retirees, other than new bargaining agreements. And then we uploaded that into your substantive plan and provided you with a copy last year, sometime in December. So we'll do the same thing this year. We'll send a questionnaire over to you sometime mid-July, around the same time we send you the annual notice. And if you can just complete that and fill that out, then we'll start gathering all of the documents that goes with it, if there are any changes at all. Any questions on that?
No.
Oh, great, thank you. That brings us into transfer of assets into the trust. So, you made it your annual contribution. Sometimes last year it was about your normal 70, 80,000. So are you in line with continuing on with the same funding schedule, or are you going to fund any one-time monies that you receive, or what's your funding schedule going to be like for the 2021-22 year?
We annually do a calculation of the percentage of retiree benefits related to federal paid work. And so we'll do that again. And that's about the 70, 80,000 that you were talking about, and no plans at this time to make additional contributions into the trust. We annually transfer from our general fund into our retiree health fund, and that has a balance at the county treasury, but no plans right at the moment to, I guess either way, no plans to contribute more into the trust or to take out of it. We've never taken out of it, and I don't believe there's plans to do that in the near future. And correct me if I'm wrong on any of that, Marlene.
Nope, that's correct.
Awesome. Okay. All right, thank you very much. So that brings us to the end of our report, our agenda. And are there any comments from either of the Retirement Board of Authority members? No, no comments. No. Any comments, Scott and Carrie?
Just thank you all.
Yes, thank you. It's good to see everybody.
Yeah, you guys look
We
great.
might be in person by now.
Yeah, for sure.
Next time.
Next time.
Hopefully.
Definitely.
Next time.
Definitely.
Yeah.
All right. So I'll get together with Shonda, and we'll probably meet, get a date on calendar for the same time next year. And then we'll just go from there.
Thank you all so very much.
Thank
And
you.
thank you so
Thank
much,
you.
Mario, for your help too.
Great to see everybody. Take care.
Yeah, good to see you all. Thanks very much.
Okay, we'll adjourn at 2 o'clock. Thank you.
Bye. Take care.
Bye.